Today I'll be showing you an options play that you can do with stocks that are pretty stagnant and don't move very much. So for this example, we're on AT&T right now, and as you can see, AT&T doesn't move very much. The lowest is 27.82 and the highest is 28.22. So it only moves by about 40 cents, and that's the past week. So if we go to the past month, biggest high 28.61, low 27.53, so that's a little over $1. So you can see it doesn't move very much. And so we're going to go over here to trade AT&T options, and I'll show you what we're going to set up here, and it definitely limits your risk. Your risk is about $11 and your maximum gain is about 300% of that. So we're going to go over to sell call, and you're going to see the share prices right here. So let's choose August 20th, and I'm recording this on August 9th right now, so this is about 11 days away. So on August 20th, where do I think AT&T will be at? And let's just say, for the example, I'm just going to say 27.50. So we're going to sell a call right there at 27.50. And then we're going to also sell a put at the same spot, 27.50. So you should get something that looks like this, but as you can see, our max loss is not limited. Our max loss is unlimited, so we want to stop that. So we're going to go and buy a put, let's say one below. So there we go. So you see this side is now fixed. So now we're going to go buy a call, and whichever gap you did for this, for the put that you bought, you want to do for the call that you buy. So since we went down one, we're going to go to the original, and we're going to go up one. So there, let's buy that. And as you can see, this is something that it should look like. You see the max loss is only $11 and the max return is $39. So that's over 300% returns for just one $11 option. You can definitely spread it out more, so let's go back here. And let's say I wanted a bigger gap, so let's say I'll go to the original and go down 2. There we go. So now this side is limited. And let's go to buy call, and then you want to do the same thing. So you went a gap from 2 from the original, so we're going to go back to the original, and for buy call we're going to go up 2. So 1, 2, there we go. So we're going to buy that. And you can see the max loss is definitely more, but you have a little bit of a bigger spread, so you're more likely to get it in that green area, but if it's not, you lose way more. So I like to do it where your max loss is limited and your max loss is small too. So this is the best way we can do it. They're going to give us $38 to put this option in place, but then let's say on August 20th the price of AT&T is at $26.80, then we lose $11. And so your max profit is the 39 that they give you, which you'll keep. And so as long as it's between 27.12 and 27.88, you're in the green area, which is pretty likely. That's about 60 cents, 70 cents of play room right there. And when AT&T doesn't move that much, and this is only 11 days away, so we're pretty likely to be within that zone if we set it right. And so when you're setting options in place, I would definitely look at all the risks that can happen. There is risk of assignment. You should look into how that works and you do your research on that. But this is definitely a limited risk play that you can do for pretty decent returns. I mean, that's over 300% in about 11 days, and no other stock can do that. It's really only option strategies that can provide this for you. But definitely look into the research behind the risks of this. But I definitely recommend trying this out, and if you have any questions, comment down below, and thank you for watching.